Chapter 10. The 7-Step Fast-Track Investment Strategy. Accelerate your money-making money. Investing is the ultimate form of passive income and the accelerator of financial freedom. It's how you make money on your money without having to exchange any of your time. The simple investing strategy presented in this chapter is designed to help you reach your number as quickly as possible. It is designed so you or anyone can implement it, no matter how much money you make or investing experience you have. It's worth noting that this strategy is specific to U.S. citizens, but if you're not an American citizen, you can still invest in the same investments, just not the same types of accounts. Many people find investing daunting or confusing, so they don't invest in dumb things, invest way too little, or pay financial advisors large fees when they could easily manage their investments themselves. Don't get distracted by more advanced or flashy strategies or complicated language. The important thing is not to become an investing wizard, but to get your money growing as soon and as efficiently as possible. The longer you wait, the more time and money you are wasting. And as I've mentioned many times in this book, every day of compounding matters. Start today. Seriously, you don't need to figure out everything before you start investing. Let me start by clearing up a popular misconception. Investing is not gambling. When you invest, you are putting money in something that gives you a reasonable chance to get that money back or see it grow. When you gamble, you are relying solely on luck to get a return. Also, unlike with gambling, when you invest, you can control many of the variables that impact whether you make money, and that can limit performance. This strategy is built on 5 key concepts you can directly influence. 1. Minimizing risk. 2. Minimizing fees. 3. Minimizing taxes on your contributions. 4. Maximizing returns. 5. Minimizing taxes on your withdrawals. While all investing carries risk, and you can't control the market, the economy, or the performance of a stock, the simple investing strategy in this chapter can help you get the highest return for the level of risk you are comfortable with and maximize your chance for success. Don't worry, it won't take long for you to find your sweet spot, the point at which you are invested in a way that will make you as much money as possible while still letting you sleep at night. Over time, you'll also get more comfortable taking calculated risks to make even more money. You can invest in a wide variety of things like art, wine, commodities, currencies, cryptocurrencies, domains, furniture, collectibles, businesses, and tons of other things. While you can make money investing in any of these things, for the purposes of this chapter, we're not going to focus on investing in physical assets or speculative financial instruments. Never invest in anything you don't understand. Don't put your money in investments that your friends or family or a financial advisor or someone you just met told you to invest in without understanding exactly what you are investing in and what the risk-reward trade-off is. Beware of trendy or too-good-to-be-true investments, things that promise a 20% return each year or something that is unlikely to happen over the long term. No matter how much you trust the people making an investment recommendation, focus on simple financial instruments that generate consistent returns over time. The core of your investment portfolio should be made up of stocks, bonds, and real estate. These are the easiest, most dependable investments, and they can make you a lot of money. While you can hire a financial advisor or company to manage your investments, as you've learned throughout the book, the more you control your own financial life, the more money you can make. You can and should implement this strategy yourself, and realistically you can manage it in less than an hour a month. Financial advisors, fiduciaries, and robo-advisors. If you need help investing, you can hire a fee-only financial advisor for a few hours to help you set up your accounts. You should work only with advisors who charge on an hourly or project basis, not based on AUM. When you are charged based on AUM, your advisor is getting a percentage of your investments to work with you, whether they make money for you or not. And the impact of those percentage withdrawals, like any other investment fee, will negatively compound over time, thus reducing the total long-term value of your investment. Also, make sure any financial advisor you work with is a fiduciary, an advisor who is legally required to advise you in your best interest, not their own. If they aren't a fiduciary, they can sell you anything they want even if it's not in your best interest, which is pretty common since many brokers receive commissions for selling certain products. Whenever you talk to financial advisors, ask if they are a fiduciary and if they receive commissions on investment products. If they say yes, don't work with them. Check out XY Planning, a network of financial advisors who charge by the hour that includes some early retirement experts. Another option is to work with a low-fee company commonly known as a robo-advisor that uses algorithms to invest your money and keep you accountable. I've personally tested a number of robo-advisors, and you can easily save your money and do everything they do on your own. But if you decide you absolutely need help managing your investments, working with a robo-advisor like Vanguard Personal Advisor Services, Betterment, or Wealthfront are good options. Just be mindful of the fees and the type of support you get. I personally like Vanguard's service because this investment strategy is designed to help you to minimize taxes, minimize risk, account for inflation, and maximize your returns. It's very close to the exact investing strategy I personally used, with some improvements that I've discovered since becoming financially independent and recommendations I've gathered from others who have fast-tracked their financial freedom. This investment strategy is designed to be done in order, so follow each step as presented. If you follow these instructions and maximize your savings rate so you're investing the absolute greatest amount of money you can, you will turbo boost your chances of hitting your number quickly. It's also a strategy you can follow for the rest of your life. Please note, all of the contribution limits mentioned are current as of 2018, so check for the most up-to-date limits on the IRS website so you can maximize your contributions. There are also different contribution limits depending on if you are single or married. Step 1. Separate short-term and long-term investing goals. You should be investing differently depending on whether you need the money in the short term or the long term. Most of your money should be invested for the long term so you can live off it for the rest of your life. Short-term investing. Because the stock market can fluctuate quite a bit over any 5-year period. If you want to buy a house in the next few years, redo your kitchen, or take that amazing trip to Italy that you've always wanted to take, then you want to put that money in investments that are less as a low fee, and you are also able to talk to a financial or tax advisor at any time if you have questions. While your investments won't grow as much as they could if you took more risk, they also won't lose as much money. You don't want the value of your money to fall 20% right before you need it because of a stock market dip. Most people hold their short-term investments in cash in a savings account so they can access the money immediately. This is an okay option if it helps you sleep at night. But most savings accounts grow at less than 1% per year, so you will actually be losing money to inflation. It's always safe to keep some of your investments in cash in case of emergencies in what's commonly called an emergency fund. Traditional wisdom recommends you save enough money to cover at least 6 months of your living expenses in cash in a simple savings account or money market fund. This allows you to have access to cash whenever you need it without having to sell any of your investments, which can be useful in case of an emergency, or if you lose your job. If you believe you have a secure job or you have cash flow from multiple income sources, or if you have access to cash in other ways, then you might be okay saving less than 6 months worth of expenses and instead investing the extra money in stocks or bonds. Personally, I've always kept less than 2 months of my living expenses in cash because I want to keep as much money as possible in the market and growing. But I'm comfortable doing this because I have multiple income streams as well as the ability to use credit cards strategically to cover any emergencies. In a worst-case scenario, you can always withdraw money from your Roth IRA account, since you've already paid tax on the principal and won't be penalized for doing so. I've always viewed my Roth IRA as a backup emergency fund. Remember, the more money you have invested, the more it can grow. Another safe short-term option is to put your money in a CD. CDs are offered by banks and will give you a guaranteed interest rate, likely around 2%, for a fixed period of time. But CDs force you to lock up your money for typically between 1 and 5 years, and you'll get penalized if you take the money out early, so you don't get the flexibility of cash if you need the money in a pinch. However, one strategy you can use is to set up what's known as a CD ladder, which is when you open CDs so they are maturing on a consistent basis, typically every year, so you can then use the money if you need it or just reinvest it in another CD. A better option is to keep your short-term investments in bonds. A bond is a form of debt issued when a company, government, or municipality needs money. It's a loan with a guaranteed interest rate attached. When you buy the bond, you are loaning money for a certain period of time at a fixed interest rate to whoever issued it. Because the interest rate is fixed, bonds are known as fixed income investments, so you can count on the returns as long as the issuer doesn't default on the loan. High-quality bonds are traditionally viewed as less risky investments than stocks because their interest doesn't change the way a stock price does. If you want to invest in bonds, you don't need to go through the hassle of buying bonds directly. You can easily buy them through a bond fund. Check out the Vanguard Total Bond Market Index Fund, which invests in a diversified group of investment-grade bonds. This particular fund contains about 30% corporate bonds and 70% government bonds. Bond funds are low risk but carry a higher potential return than most savings accounts. This allows you to at least keep up with inflation. Between 2012 and 2017, the Vanguard Total Bond Market Index Fund has returned approximately 2 to 3% each year. When you have money invested in a bond fund in an after-tax account, you can withdraw the money at any time. You will just be responsible for paying taxes on the gains. If you want to take a little more risk, you could invest your cash in a fund composed of both stocks and bonds like the Vanguard Wellesley Income Fund, which invests in approximately 60% bonds and 40% stocks, so you can generate a higher return. Over the past year, the Wellesley has returned 10.2%, over the past 3 years, 6.45%, and over the past 5 years, 7.31%. That sure beats the 1% or less that most savings accounts offer. If you have access to consistent secure cash, then don't keep your money on the sidelines unless you plan to actually retire in the next few years and will need to live off your investing income. As you get closer to early retirement, you should increase your cash fund from 6 months of living expenses to 12. Long-term investing. No matter when you start investing, a majority of your money should be invested for the long term. Because even if you plan to retire earlier than that, you will want to keep the money growing so you can live off it forever. Buy and hold is the name of the long-term investment game. Because you have a longer time horizon, short-term fluctuations in your investments don't matter as much because they have a longer time to recover from losses. The best places to invest for the long term are in the US and international stock markets. The rest of the investing strategy presented in this chapter is designed for long-term investing. Step 2. Figure out how much money you have to invest. As you already know, the higher your savings rate, the more money you can invest and the faster you'll hit your number. Sit down and think about how much money you can invest each day, month, quarter, and year. Set a foundation, a baseline number that you are going to invest in each account over each period. Whether it's getting a percentage withdrawn from your paycheck and deposited into your 401 or having a certain amount transferred from your bank account into your portfolio each month. Automate as many of your deposits as you can into each account. But remember, automation is just the start. Don't just set it and forget it. Try to push your investing foundation as high as you can as frequently as you can by escalating the amount you are withdrawing from your paycheck and the amount of your side hustle income you are contributing. Try to escalate your investing rate at least 1% every 30 days and reevaluate every 6 months. Keeping this habit up, you will save at least 12% more every year. If 1% feels easy, then try for 2%, 5%, or larger increases. Once you start investing more, saving becomes a lot easier. The hardest part for many super savers, myself included, was going from 0% to 20%. But at a 20% investing rate, you really see your money starting to grow, which is motivating and makes going from 20% to 50% a lot easier. If it's easier for you to think in dollars instead of percentages, try to invest as much as you can every day. In 2011, I started trying to invest an extra $50 a day into my retirement accounts on top of my contributions that were automated. As I started making more money, I would invest as much as I could each day, sometimes as much as $200 extra some days when I made extra money. Once I had invested the money, I didn't miss it and enjoyed seeing my account balances grow. Remember, even one extra dollar invested every day will make a difference. Push yourself to invest as much as you can every day. It's an investment in the future you. On this page is an example of a simple spreadsheet format you can use to plan and track your savings rate. In this example, the person's target savings goal was $18,360 by the end of the year, which equals a 25.5% savings rate. But they were actually able to save $21,100, which is 29.3%. Using a simple spreadsheet like this or the tools I've built to help you track your information can help you push to save more. Step 3. Determine your target asset allocation. Next, you need to determine your target asset allocation, which is the percentage of each asset you have in your investment accounts. Your target asset allocation determines the level of risk, reward of your investment portfolio and is one of the most important investment decisions you will need to make. No matter which target allocation you choose, you will need to monitor and maintain this asset allocation across all of your investment accounts. Typically, stocks are riskier investments than bonds, so the more stocks you hold in your portfolio, the riskier it is, meaning the more it could go up or down in value. Bonds fluctuate less than stocks, meaning they have less risk but also less reward potential. And cash is cash, so it's not going to go up in value much and, as you've learned, will likely lose value over time due to inflation. So having a portfolio invested 100% in stocks is riskier than having a portfolio invested 60% in stocks and 40% in bonds or 40% in stocks and 60% in bonds. If the stock market goes down, the more you have invested in bonds, the less your portfolio will likely go down. But the more you have invested in bonds when the stock market goes up, the less it will increase in value. The typical advice is that you should set your bond allocation to your age, but age-driven asset allocation recommendations are misleading because they assume you will retire in your 60s and 70s. While they might work for many people who don't want to retire early, they might not work for you and can expose you to too much risk and minimize your returns. The best way to pick your target asset allocation is to estimate how long it will be before you need to use the money. The longer time horizon you have before you need to withdraw your investments, the riskier your target asset allocation should be, because you have more time to weather short-term ups and downs and participate in the long-term potential gains. Here are 2 simple rules to follow. 1. The further away you are from retirement and the longer you plan to keep your money invested before withdrawing it, the more risk you should take, so the greater your stock allocation percentage should be. 2. The closer you are to retirement and the sooner you need to live off your investment balance, the less risk you should take, so the greater your bond allocation percentage should be. If you are 10 or more years away from retiring, I recommend you invest 100% in stocks for now. When you are 5 years from retiring, then depending on how well the market is performing, you will want to readjust your asset allocation to be more conservative. After you retire and depending on how long you need the money to last, you will want to shift your asset allocation to focus on generating consistent income with less risk. But if you aren't actually planning to retire completely, you can maintain a higher level of risk in your portfolio and continue to let the money grow at a higher rate. Brandon, who reached financial independence at 32 and is now 36, keeps 100% of his portfolio invested in stocks because he is still making money from his blogging side hustle and he's confident in the long-term prospects of the U.S. stock market. As I write this at 32, I also still have 100% of my investments in stocks for a similar reason. I am still making money and also believe in the long-term growth of the stock market. If I didn't have any additional income, then I would likely switch to a more conservative allocation closer to 70% stocks and 30% bonds. There is no hard and fast rule. Your target asset allocation will fluctuate as you invest more money and your plans change. On the other hand, Christy and Bryce, who reached financial independence at 31 and 32, respectively, and are now in their mid-30s, are more conservative and have shifted their investments to 60% stocks and 40% bonds so they can get a fixed amount of pretty much guaranteed income. No matter what happens in the stock market, their investments are set up to generate between $30,000 and $40,000 in dividends and fixed income while maintaining their investment principal. They prefer the security over the growth potential, but since they do have 60% invested in stocks, they can still participate in the gains as the stock market goes up, just at a lower rate than Brandon or I do. JP, who reached financial independence at 28, is also conservative, but not as much as Christy and Bryce. She has about 70% of her portfolio in stocks and 30% in bonds, fixed income. On the facing page is a chart of asset allocation recommendations based on your age and years to retirement. While I still recommend you use years to retirement as the guide, I've also included baseline age asset allocation recommendations since they are a good reference point if you are just starting out. Please adjust these as you see fit, and also remember that you should adjust your asset allocation as you get closer to wanting to retire. How you set your allocation is up to your appetite for risk, reward, and what helps you sleep at night. To help you determine your own target asset allocation, the chart below shows the past performance of each allocation percentage over the past 1, 5, 10, and 20 years. For the stock investments, the money is invested in the Vanguard Total Stock Market ETF Index Fund, and the bond investments are in the Vanguard Total Bond Market ETF Index Fund. As you can see, over the past 10 years, the returns of a 100% stock portfolio would have outperformed the returns of a 100 annual percentage return T% bond portfolio by 4.54% per year. In the past year, the same 100% stock portfolio would have returned 17.54% more than a 100% bond portfolio. While these types of returns of course aren't guaranteed, these are solid benchmarks you can use to select your own target asset allocation. After you determine your target allocation, you should maintain it across all of your investment accounts. This doesn't mean that if your target asset allocation is 60% stocks divided by 40% bonds that you have to have 60% stocks divided by 40% bonds in every investment account. It just means that your total allocation across all accounts hits those target percentages. You could have 100% of your 401 in stocks and 80% of your IRA in bonds, but it could average out to 60% divided by 40% depending on the amount of money you've invested in each. The easiest way to monitor your allocation is to use a free net worth investment tracking app that you can find at financialfreedombook.com/tools. Once you set up your investments to align with your target asset allocation, you should try to maintain this allocation as you invest more money and the market fluctuates. Maintaining your allocation will help ensure that you get the highest returns possible based on the level of risk you are willing to take. Readjusting your allocation rates so they align with your target allocation is known as rebalancing and should be done quarterly. For example, because of market fluctuations or automated investing, your 60% divided by 40% target could become 80% divided by 20% if, say, stocks go way up and increase in value exponentially over bonds. For instance, let's say you invest $100,000 in 80% stocks and 20% bonds. Over the next several months, the stock market averages a return of 20%, which means you end up with $96,000 in stocks. Meanwhile, bonds averaged a return of 3%, so you have $20,600 in bonds, for a total portfolio of $116,600. Your allocation is now weighted 82.3% in favor of stocks and 17.6% in favor of bonds, so your target of 80 over 20 is off, exposing you to slightly more risk. This is why it's important to rebalance 4 times a year. Simply sell some of the assets you have too much of and use that money to purchase more of the assets you should have more of to get back to your target asset allocation. In this case, you could also buy more bonds to rebalance. In many cases, it's always better to buy more of an asset to rebalance, since you are investing more money and don't have a potential tax consequence for selling your investments. However, if you do decide to sell your investments to rebalance, you should do it within your tax-advantaged account so you won't have to pay taxes on the selling and repurchasing of stocks or bonds. Step 4. Evaluate your current fees. Investment fees can have an enormous impact on how quickly your money grows, how much money you'll have within a given time frame, and how many years it will take you to reach financial independence. Any company that holds or manages your investments is going to charge a fee to do so, and there are typically multiple layers of fees when investing. For example, if you invest in your company's 401 plan, you pay a fee to the company that manages the plan and also to each company that manages the investment vehicles inside the 401. Also be on the lookout for what are known as load fees, which are extra fees that some 401 and 403 management companies sometimes charge if they are smaller, and that's just for your 401. You will have fees for all of your investments and investment accounts. The more you pay in fees, the less money you have compounding, and while 0.5 to 1% of your investments might not seem like a lot, it adds up over time. Remember that compounding works both ways, so every 0.1% in fees negatively compounds year after year. Fees also have a bigger impact the younger you are, since the impact of the fees has longer to compound. I was recently talking with a married couple, whom I'll call Jim and Jane. Jim and Jane are both lawyers and work 70-plus hour weeks and travel constantly, leaving their kids at home with a nanny. They are both making a lot of sacrifices to make a lot of money, but when we started discussing their investments, they eventually admitted that they were working with a financial advisor who charges them 1% of their investment assets every year to manage their accounts, even if their investments are down. During the conversation, they also confessed that they really didn't know what they were invested in. But our money is growing, they told me. And we are happy enough with our advisor, who is one of Jim's longtime friends from college. While I don't have the couple's entire financial history, I do know that they have at least $1.5 million in investments and they are in their early 40s. So the table below is a very realistic scenario to show the impact of their investment fees on their portfolio. Let's assume they started with $100,000 in investments and contribute $75,000 to their investments every year for 25 years. Check this out. Fund 1. Investing directly in stock market index fund charging 0.04% in fees. Fund 2. Investing in actively managed funds with a financial advisor fee for a total fee of 2.2%. As you can see, because of the 2.2% in investment fees they were charged, they lost 29.2% of their investment returns over that 25-year period. If they invested in a simple index fund with low fees that tracked the U.S. stock market, instead of working with a financial advisor and investing in actively managed funds, they could have $1,490,284 more when they retire. That's a massive amount of money they could have if they just paid a little bit more attention and invested in mutual funds with lower fees and managed their investments themselves. Even if you don't have millions of dollars to invest, a small difference in fees can potentially subtract hundreds of thousands of dollars from your potential earnings. Fees also matter once you do retire. Because if you are living off 3 to 4% of your investment gains and your investments are growing an average of 7% per year, then taking out another 1% for fees means you will be able to keep only 2 to 3% of your investment gains in the market. If you have investment accounts, I encourage you to check your fees right now by looking at your investment statements and the prospectus of each fund you invest in. Fill out the annual fee chart below. For investment accounts, note the percentage you are being charged to have your investments managed, as well as any additional administrative fees. In the account column, list the type of account. In the investment column, list the investment. In the company fee column, list the annual fee the company holding your investments charges to hold the investment. This is typically an annual management fee charged by the 401 company your employer uses or an annual fee the company who manages your IRA might charge. Next, list any investment fees a company charges to manage the actual investments. The company that manages the investment charges you a percentage of your balance in that investment, which is known as the expense ratio. For the Vanguard Total Stock Market ETF Index Fund, the expense ratio is 0.04% as of this writing, which means you have to pay 0.04% per year of the money you have invested in that ETF. This is a really low expense ratio. Finally, list any fees you pay for a financial advisor if you have one. Below is a hypothetical snapshot of someone's investments and their fees to show you what your chart could look like. Remember, even a small difference in fees can make a massive difference over time, so any fee over 0.30% should be reevaluated, since there are likely more affordable but similar investment options you could choose. In some cases, as with your 401, the fees are determined by the company your employer chooses to administer the plan, so you likely won't be able to reduce them. But if the fees are high, definitely talk to the Human Resources Department at your company to see what they can do. Step 5. Pick the right investments. Next, we are going to pick investments that have low fees, minimize the impact of taxes, and maximize your returns. While you can pick any investment you want within your IRA accounts, your 401 investment options will depend on what your company plan offers. While you could theoretically go out and buy a bunch of individual stocks and bonds to diversify your portfolio, the easiest way to diversify your investments is to buy mutual funds or ETFs. These are packages of investments that allow you to invest in multiple stocks or bonds at once without having to buy a bunch of different individual products. Both mutual funds and ETFs are built for the purpose of simple diversification, and either type of fund holds a collection of stocks, a collection of bonds, or a mixture of stocks and bonds. These funds are typically built around a theme or sector, meaning they hold a group of investments of a specific type or within a particular industry. Mutual funds and ETFs are very similar, but mutual funds are priced only once a day by the fund insurer, while ETFs behave like stocks and their value can fluctuate throughout the day. Fees for owning these funds are often similar, though ETFs tend to be easier to manage and have no investment minimums. Most companies offer a selection of 5 to 30 mutual funds or ETFs that include U.S. and international stock funds, bond funds, blended funds, target date funds, as well as funds for things like gold and cash. In order to try to make investing easier, some 401(403) providers will offer what are called model portfolios, which are designed around a certain level of risk, from conservative to aggressive, and allocate the included investments in a way that aligns with that risk level. But these model portfolios often have high fees and are overly complicated. You should question any of the default investment options or selections in the account, since some 401 providers recommend the ones that will make them the most money, and aren't necessarily best for you. Also remember that you get charged fees for all of the investments you hold within your 401 or 403. Each fund will have its own management fee, expense ratio, so when you are evaluating which mutual funds to invest in, look at the fees for each one. If the fees are over 0.30%, then they are expensive and you should consider other options. The case for index funds. When you buy stock, you are buying a share of ownership in a real company. This means you literally own a small part of the company. As the company makes money or as people believe the value of that company will go up, the price of the stock can go up. The greater the demand for the stock and the more people believe in it, the higher the price can go. It can also go down if the opposite is true and the demand for the stock goes down. Stocks are traded all over the world on many different exchanges. This investing strategy splits stocks into two types, domestic and international. If you look at the stock market over relatively short periods of time, you might start to think that investing in stocks resembles gambling more than a safe bet. But over the long term, stocks have proven to be an incredibly reliable investment. While the entire stock market can swing wildly from one day to the next, and there is certainly risk in investing in stocks, as the country grows, wealth grows and the value of companies, and therefore the value of their stock, continues to grow. On October 19, 1987, the U.S. stock market dropped 22.61%. On March 15, 1933, the stock market was up 15.34%. These are huge daily swings. But over the past 100 years, the entire U.S. stock market has grown an average of 7.3% per year. You can see the daily ups and downs in the stock market in the chart opposite, but the trend has always been up over time. Unfortunately, many investors don't think about the long term and instead try to get the highest return possible today. When their accounts are down, they sell, thereby guaranteeing that they lose money. Individual stocks can swing wildly in value over both short and long periods of time, which can either make or lose you a lot of money in a relatively short period of time. If you had bought $5,000 in Amazon stock in 1997, it would be worth at least $2.5 million as of this writing, because during this period Amazon has gone from $18 a share to over $1,200. But since you are investing in a business when you buy stock, there is always the chance that the business could go under and you could lose all of your money. Shares of Enron, an energy trading company, went from a high of $90.56 in the year 2000 to a low of 67 cents in January 2002. Stockholders ended up losing a collective $74 billion from investing in Enron stock. While you might be an amazing stock picker, the odds are against you, and the work required to research, analyze, and invest in a selection of companies that you hope will grow faster than the stock market just isn't worth your effort and time. Research shows that, on average, 90% of active investing yields a disappointing performance compared to the stock market as a whole over a 15-year period. So instead of going out and investing in just one or a few stocks, trying to pick the next Amazon, you will beat 90% of all active stock investors by simply investing in a broad diversified group of U.S. stocks. When you invest in the entire stock market, you are much more likely to achieve the same long-term gains as the whole market, which, as I've already pointed out, has averaged a 7.3% gain per year over the past 100 years. Thankfully, it's really simple to invest this way, and you need to buy only one type of investment fund that you can buy in all of your investment accounts. To keep your investments as efficient and effective as possible, you should invest in a simple fund that owns a broad selection of the U.S. stock market or a fund that owns a small piece of the biggest 500 companies in the United States. A total market fund tracks the performance of the U.S. stock market by investing in over 2,000 stocks in the United States. An S&P 500 fund is similar but tracks only shares of the top 500 largest companies in the United States. Because they contain such a broad array of stocks, total stock market index funds allow you to easily invest in a diversified portfolio, and because they are passively managed, they typically have very low management fees and are tax efficient. Investing in index funds also gives you the opportunity to receive dividends from those stocks that issue them, which help to generate consistent investment gains. While a total stock market fund offers more diversification, because it invests in more companies, the S&P 500 is also diversified, and the largest 500 companies in the United States generate a disproportionately high percentage of the profit and growth of and represent about 75% of the entire U.S. stock market. Many companies offer an index fund that tracks the U.S. stock market, and many companies actually offer two levels, where you pay a higher or lower fee based on how much you invest. Some of the most popular index funds with the lowest fees are the Vanguard Total Stock Market Index Fund and the Vanguard Total Stock Market Index ETF, both of which hold the top 2,800 stocks in the United States. The Schwab Total Stock Market Index ETF, BlackRock's iShares Edge MSCI MinVol USA ETF, and the Fidelity Total Market Index Fund Premium Class. There are also many companies that have an S&P 500 fund, like the Vanguard 500 Index Fund Investor Shares, the Vanguard 500 Index Fund Admiral Shares, the Schwab S&P 500 Index Fund, and the Fidelity Spartan 500 Index Shares. You might be wondering whether you should pick a total U.S. market fund or an S&P 500 fund. Depending on who runs your retirement accounts at work or the investment company you choose, you may have access to either a total U.S. market or an S&P 500 fund, not both. Either would be a great choice, and the long-term investment returns will likely be similar between the two. Using the Vanguard 500 Index Fund and Vanguard Total Stock Market Index Fund as examples, in the table below you can see the returns over the past 1, 3, 5, and 10 years were pretty similar. If you are currently investing, How well do your portfolio returns compare to those of either a total stock market or S&P 500 fund? To update these comparison performance numbers, simply do a Google search or go to Vanguard's tool to compare the performance of any two funds. Have you been one of the rare people to beat the stock market over the past 1, 3, 5, or 10 years? While it's definitely possible to beat the market over a 1-year period, it's really hard to do over a period of 5+ years and to beat it consistently over the long term. Socially responsible index investing. While the returns of a total stock index fund are tough to beat, they can come at a price. One problem I have with total stock index funds is that because they hold a collection of almost all stocks in the U.S. markets, they invest in some companies that have questionable labor, environmental, and health practices. For example, when you buy into an index fund, you are supporting big tobacco, big pharma, and companies that have previously been investigated for violating child labor laws. The older I get, the more important socially responsible investing is becoming to me. So I've started to shift some of my own investments into funds designed for socially responsible investing, like Vanguard's FTSE Social Index Fund. A good ETF to take a look at is the iShares MSCI KLD 400 Social ETF. While you are going to sacrifice some returns and the fees are a bit higher with these funds than they are with a total stock index or S&P 500 fund, it might help you sleep better at night knowing that you are investing only in companies that are doing good in the world, or at least not doing bad. In addition to investing in a U.S. stock index fund, if you think that the U.S. stock market is going to perform poorly in the future, you can consider investing a small portion of your portfolio in an international stock index fund for broader diversification. Investing outside of the United States is generally considered riskier, but is useful for diversification because international markets have historically behaved differently from the U.S. stock market. Adding an international stock index fund to your portfolio might give you greater growth potential over the long term, but I recommend you invest no more than 5% of your portfolio in an international stock index fund, which is far below the 30% that many investment advisors currently recommend. To keep your investments as efficient and effective as possible, you should invest in index funds whenever possible across all of your accounts. You should also set up all of your index fund dividends to automatically reinvest within the index fund. This means that whenever a company issues a dividend, you will automatically be using the dividend to buy new shares of the index fund to keep your money growing and compounding. If you withdraw your dividends, then the money will either sit in cash within your tax-advantaged account or you will be responsible for paying taxes on the withdrawals from a taxable account. If you do decide to withdraw your dividends for some reason, likely to spend the cash or invest it in something else, some dividends get taxed at a lower qualified dividend tax rate equal to the capital gains tax rates, so you can take the dividends as income and pay less tax than your income tax bracket. If your target asset allocation is 80% stocks divided by 20% bonds, you should have 80% of your money in stock index funds and 20% of your money in bond funds. You can often get becoming easier as more funds are being launched regularly, but as with any investment, make sure you do your homework and understand the return trade-offs you are making. All the diversification you need with 1 or 2 stock funds and 1 or 2 bond funds in what's known as a simple 3-fund or 4-fund investment portfolio. Don't overcomplicate it. Keeping it simple will make it much easier to minimize fees, minimize taxes, monitor performance, keep diversified, and easily rebalance to maintain your target asset allocation. For your stock allocation, opt for a total stock market index fund, which tracks the performance of the entire U.S. stock market whenever one is available. If you want to be a little more aggressive, you can invest most of your money in a total U.S. stock market index fund and then a small percentage in an international stock market fund. My investment accounts have always been invested in a few simple index funds, a total stock market index fund and an international index fund. If you don't have a total stock market index fund, then the next best selection is an S&P 500 index fund. Building your total stock market fund if you don't have access to one. If you don't have access to a total stock market fund, then you can invest in funds to mirror the holdings of those types of funds. In other words, you can create your own diverse portfolio based on a mixture of stocks for different sized companies that will approximate what you would get in a total market fund. While it will take you a little bit of time to design your own diverse portfolio, it's actually pretty easy and well worth your time to achieve optimal diversification. All of the publicly traded stocks in the United States fit within one of 3 buckets: large cap stock funds, mid cap stock funds, and small cap stock funds. You can invest in one fund of each type to build a portfolio that is similar to a total stock market index fund. To do this, I recommend investing 40% of your stock allocation in a large cap fund, 30% in a mid-cap fund, and 30% in a small cap fund. This will give you the right amount of diversity. For your bond selection, most bond fund options you will have access to in your 401 403 will likely be pretty similar, so you should pick the bond fund with the lowest fees and the most diverse selection of bonds. You can figure this out by looking at the prospectuses for each fund, which are available on either your 401 plan website or through a simple Google search. Look for a bond fund that has a collection of government and corporate bonds. Remember, you are using bonds to mitigate the risks of your stock holdings, so you don't need to take a lot of risk. Typically, most bond funds will average a return of 2 to 4% compounding per year. Look at the 1, 5, and 10-year historical performance of the bond funds and pick one that generates a relatively high and steady return. You can also consider investing in leveraged municipal bond funds, which are issued by local and state governments and are a good tax-efficient option and generate a consistent amount of income. You can invest in them easily through a municipal bond ETF. These are popular bond investments for early retirees who want to generate a fixed amount of income. In the chart on this page, you will see a number of popular types of funds and investment options in 401 403 plans. Note that the ones your company offers may have different names depending on the company that offers them. I've also included recommendations for how you can achieve your target asset allocation using the funds typically available in these types of accounts. These can also be used to meet your target asset allocation in your IRA. Also note that where there is no percentage recommendation for a particular type of fund, it is because I don't recommend these investments if the others are present. You can use this chart as a starting point to create your own diversified portfolio. You can ignore all of the other options, things like gold and REITs in your 401 seconds, 403 seconds, or IRAs. While they can add diversification, they aren't really necessary and you are better off focusing just on stocks and bonds in your asset allocation. Keep it simple using total stock market, S&P 500, and total bond market index funds when you can. Step 6. Max out your tax-advantaged accounts. Taxes can take a massive chunk out of the future earnings of your investments, so it's important to minimize their impact as much as possible. If you're not currently a money nerd, this is how you become one. Learning about tax optimization might sound boring, but it will save and make you a ton of extra money in your investments. Here's how much. Let's say you make $100,000 per year and plan to invest 10% of your salary per year and need to decide whether to invest it in a tax-advantaged or taxable account. You are in the hypothetical 30% tax bracket and your employer offers a 4% salary match for your 401 contributions. Here's the performance difference of that single $10,000 per year investment over the next 30 years. When you invest in a tax-advantaged account like a 401, you can contribute that money without paying taxes on it. So if your contribution is $10,000 with your employer contribution of 4%, your total contribution is $14,000. Growing at 7% per year over the next 30 years, that $14,000 would be worth $106,572. Let's say you contribute that same $14,000 every year over the 30 years. Because of the impact of ongoing contributions and compounding, you'd have contributed $300,000 of your own money and your employer would have contributed $120,000. This $420,000 growing at 7% per year over the next 30 years would be worth $1,521,594. Because you contributed $300,000 of your own money, your investment return would be $1,221,594. When you withdraw it in retirement, likely your income will be much lower. So let's say you are married and filing jointly and in the 12% tax bracket. You would have approximately $1,369,434 or a $1,069,434 return on your original investment. Now, if you invested that same $10,000 in a taxable account, you would have to pay your 30% taxes on the money before investing it and you wouldn't get any employee match, so you would be able to invest only $7,000. That $7,000 growing at 7% per year would be worth $53,286 after 30 years. And if you contributed the same $7,000 in the taxable account each year, growing at 7% each year, it would be worth $760,797 after 30 years. You would have contributed $210,000 over that 30-year period, resulting in investment profits of $550,797. If you are in the same position and married and filing jointly, you would be subject to a capital gains tax. So if you kept your income under $77,200, then you would pay 0% tax on the gains. The return of investing in a tax-advantaged account with an employer match was huge. Investing in a tax-advantaged account, you would have $760,797 more money in your account and $608,637 more to spend after paying taxes when you withdraw the money. The key to getting the maximum tax benefits is to strategize. 1. When you put money into your investments. 2. When you take the money out of the investment. With a tax-advantaged account, you are able to take a tax deduction when you invest new money into the account or when you withdraw money from the account. There are big advantages with both types of accounts. Optimizing for taxes will make a difference not only in how much money you have to live on today, but also in how much you have to invest for the future. You can invest in 3 types of investment accounts. 1. Tax-free contributions. Tax-advantaged accounts where you don't pay taxes when you invest the money, but you do pay taxes when you withdraw money. Types of accounts. 401 offered by employers. Solo 401 for individuals with self-employment income. 403, 457, Traditional ERA, SEP ERA, HSA. Investment principal, contributions, taxed on withdrawal. Investment gains, taxed on withdrawal. Tax deduction. In most cases your contributions are tax deductible, so they reduce your amount of taxable income. Withdrawal policy, 10% early withdrawal penalty if you withdraw before age 591/2, but there are strategies to eliminate this penalty. Contributions limits, yes. 2. Tax-free withdrawals. Tax-advantaged accounts where you pay tax before you invest the money, but don't pay taxes when you withdraw money. Types of accounts. Roth 401 offered by employers, Roth ERA. Investment principal, contributions, taxed before contribution. Investment gains, not taxed on withdrawal. Tax deduction. Your contributions are not tax deductible. Withdrawal policy. You can withdraw contributions anytime tax-free from a Roth ERA. There is a 10% early withdrawal penalty on investment gains if you withdraw before age 591/2, but there are strategies to eliminate this penalty. Contribution limits, yes. 3. Taxable accounts where you pay tax before you invest the money and also when you withdraw it. Types of accounts. Stock and mutual fund holding brokerage accounts. Investment principal, contributions, taxed before contribution. Investment gains, taxed at withdrawal. Tax deduction. Your contributions are not tax deductible. Withdrawal policy, no penalties. Contribution limits, no. This doesn't mean you shouldn't pay your taxes. It means that you should use the tax law to your advantage and pay what you actually owe. Many people pay a lot more in taxes than they should be paying. You can optimize your money by using the right accounts in the right way and to their maximum benefit. There are many types of investment accounts, some designed for retirement planning offered by an employer and others for individual investors. While many employers offer some form of a retirement account, there are often restrictions on what kind of investments you can make in them. Typically, investment options in employer-managed accounts are limited to a few funds, which limits the control you have. For example, you can't buy individual stocks within a 401 account offered by your company, but you can in your own ERA or brokerage accounts. There are also restrictions on which types of tax-advantaged accounts you can have at the same time and contribute to in each year, as well as how much money you can contribute within a given year. The most popular types of tax-advantaged accounts with their limits, advantages, and limitations are highlighted in the chart below. Now that you know what to invest in, here's how you should maximize each account. You should always try to max out your tax-advantaged retirement accounts before investing your money anywhere else. There are 2 types of tax-advantaged accounts, those offered by most employers and those that you can buy on your own, which are known as IRAs. While there are some restrictions that we will cover, you should maximize your contributions to both of these types of tax-advantaged accounts. There are 2 types of both 401 seconds and IRAs. There are the traditional plans, which allow you to contribute money tax-free until you withdraw it at a later date. And then there are Roth accounts, which are taxable upfront but not on withdrawal. In other words, you can withdraw money tax-free. Not all companies offer Roth options, but they are getting more popular. How to invest in each of your accounts. A quick reminder that what follows is the most tax-efficient order to invest in each of your tax-advantaged accounts. However, you might find a reason to diverge from it based on your specific situation or goals. There are also always going to be exceptions to these guidelines, since there are way too many nuances to be covered in this book and there will likely be tax law changes in the future. As with all of these investment recommendations, please use this as a set of guidelines to adapt to your personal situation over time. Max out your government 457 plan if you have one. A Government 457 plan is hands down the best tax-advantaged investment account available because you are allowed to withdraw the money penalty-free before you are 591 over 2. This makes it a great early retirement investment option since you can use the money whenever you want in the future. While there is no early withdrawal penalty, you will be taxed on your withdrawals at your income tax rate. However, note that this benefit is typically only for government-offered 457 plans, not 457 plans offered by non-government agencies, which have more restrictions. If you work for yourself, you can contribute money as both an employer and employee up to $53,000. HSA. Individuals, $3,500. Families, $7,000. Over 55, $1,000 more. Your contributions and investment gains continue to roll over each year. Another great benefit of the Government 457 plan is that if you have one in addition to a 401 or 403, then you are in luck, because you can contribute $19,000 to each account per tax. If you want to retire early and have a Government 457 plan, you should max it out before investing in any of your other tax-advantaged investment accounts. If you don't have a Government 457, but you have access to a 401 or 403 plan, you should contribute enough to get your employer 401 or 403 match. The next, and likely first, account you should take full advantage of is your 401 or 403 offered by your employer. If your employer offers a matching contribution on its 401 or 403, contribute as much money as you need to get the full employer match. For example, if your employer matches 100% of your contribution up to 4% of your salary, then contribute 4% of your salary. Some employers match only 50% of your contributions, but that's still like getting a 50% return on your money, so you want to max it out. This is completely free money. 401 accounts come in two forms, traditional and Roth. Here are the guidelines for whether you should contribute to a traditional 401 or a Roth 401. Many employers don't offer a Roth 401, but if they do, then whether you should choose a traditional 401 or Roth 401 depends on if you believe your tax bracket will be higher or lower in the future when you need to withdraw the money. Typically, you would expect your income to be less when you retire, so taking the tax deduction today by contributing to a traditional 401 per tax would be a wise choice. But if you anticipate that you might be making a lot more money in the future or that you will move to a higher tax bracket, then a Roth 401, to which you contribute after tax dollars, would be the better choice. However, if you plan to retire early and want to withdraw your money before you are 591 over 2 years old, the Roth 401 presents a few challenges, so I recommend you invest in a traditional 401. Because your tax bracket will likely be lower when you retire, so taking the tax break up front makes the most sense. As I already mentioned, the traditional 401 will give you more opportunities to eliminate early withdrawal penalties through a Roth conversion ladder. In most cases, if you qualify for the tax deduction from a traditional 401, then you should invest in a traditional 401 over a Roth 401. The benefits of investing in a 401 or 403 are that you are able to 1. Contribute the money without paying taxes on it first. The advantage is that you are able to invest at least 10 to 37% more money, which means more money that can grow and compound over time. 2. You can deduct the contribution amounts from your taxable income, so you end up paying less income tax. The advantage is that since you are able to deduct your contributions to your retirement accounts from your taxable income, you end up paying less tax now. And depending on your other tax deductions, your contributions might push you into a lower tax rate, thereby further reducing your entire tax bill. 3. Many employers offer a contribution match, which is free money and will amplify your investment returns. Many employers offer to match your contributions based on percentage of your salary between 2 and 5%. Always contribute at least enough to get the match. Next, max out your health savings account if you have one. With healthcare costs continuing to rise, some employers are offering HSAs, to which you can contribute pre-tax money to help cover your medical costs. Two of the biggest benefits of contributing to an HSA account, and why you should contribute to it before your IRA, if you have one, are that you are able to both deduct your contributions from your taxable income and to use the money you contribute tax-free anytime for medical expenses. This means you get double the tax benefits, because you get a tax deduction when you contribute the money and when you withdraw it tax-free to use for medical expenses. Huge benefit. Your HSA is also just like having another retirement account because you get to keep any money you don't spend each year, and your investments will continue to grow and compound each year you don't use the money, just as in a 401 or IRA. You can then withdraw from your HSA to cover your medical expenses at any time if you need the money, but if you let it keep growing after the age of 65, you can then withdraw your investment and investment gains to use for any purpose, even if it's not medically related. To take full advantage of the tax benefits of an HSA, you should maximize your contributions to it each year and pay for your medical expenses out of your cash account if you can afford it, leaving your HSA contributions invested to maximize its growth over time. You can contribute up to $3,500 per year if you are single and $7,000 if you are married. If you are over 50, you can contribute an extra $1,000, so it's $4,500 per year if you are single, $8,000 if you are married. It's worth noting that you typically need to enroll in a higher deductible health insurance plan when you enroll in an HSA. So if you have medical issues or go to the doctor a lot, you might end up spending more on medical bills using an HSA. Run the numbers to see if it makes sense for you. Open and max out an IRA. As of this writing, you can contribute up to $6,000 a year to your traditional IRA or Roth IRA. Whether you should invest in a traditional IRA or Roth IRA account depends on how much money you are currently making, what your tax bracket is after deductions and exemptions, and whether you believe your tax bracket will be higher or lower in the future. Here are some guidelines. 1. If you are in a low tax bracket and qualify based on your income level, you should invest in a Roth account so you have the ability to withdraw the money tax-free when you might be in a higher tax bracket. 2. If you make too much money to contribute to a Roth, then you should contribute to a traditional IRA because you can take the upfront tax deduction on your contribution, reducing the amount of taxes you pay today because your tax bracket is likely going to be higher today than when you choose to retire. If you plan to retire early, then there are distinct advantages to investing in a traditional IRA account over a Roth IRA account, since you can eliminate the 10% early withdrawal penalty by eventually converting your traditional account to a Roth IRA account as you get closer to retirement. Because of a strategy known as a Roth IRA conversion ladder, you can withdraw the money you converted from your traditional IRA to a Roth IRA and paid tax on 5 years later without paying the 10% withdrawal penalty and tax-free because you paid tax when you converted the money. 3. If you make too much money to take the traditional IRA deduction, then you should invest in a non-tax deductible traditional IRA and immediately do a backdoor Roth IRA conversion and convert the contribution to a Roth IRA. Even though you make too much money to contribute to a Roth IRA, the IRS allows you to do a conversion and pay tax on any money you convert if you haven't paid tax on it already. But if your income was too high to take the traditional IRA deduction, then you have already paid tax on your traditional IRA contribution, so you have to pay taxes only on the gains. If you already have a balance in a traditional IRA that you previously took a deduction for, you could be subject to additional taxes when doing a Roth conversion. If that's the case, it's still worth doing a conversion, but you might need some help from your IRA company to do the conversion in the most tax-efficient way. Most investment companies that manage IRAs have tools that let you do this conversion easily. If you do the conversion right away, you don't have to pay any taxes on the conversion as long as you don't have any other money in a traditional IRA. A quick recap. Since we covered a lot, if you qualify for a Roth IRA, then you should invest in one. But if you don't qualify for a Roth, then you should invest in a traditional IRA and take advantage of the tax deduction. And if you don't qualify for a tax deduction, then you should invest in a traditional IRA and do the backdoor Roth conversion. While this might sound a little complicated, you will pick it up quickly after doing it once, and then each year your contributions will just be a regular part of your routine. Next, max out your 401 or 403. If you make more than $137,000 as a single person or $203,000 as a couple, then you can't contribute to a Roth IRA. If this is the case, then you should go ahead and max out your 401 or 403 to take advantage of those tax benefits. As of this writing, you can contribute up to $19,000 in your 401 or 403. If you have a side hustle or work for yourself, set up a SEP IRA or solo 401 and invest as much money as you can. If you have a side hustle in addition to your full-time job, and you've already maxed out your 401 in IRA, then you should open either in SEP IRA or a solo 401 so you can invest some of your side hustle money pre-tax. Here is how to choose between a SEP IRA and a solo 401. In a SEP IRA, you can contribute up to 25% of your income, which ends up, after Social Security and Medicare taxes, being approximately 20% of your annual profit. If you make $100,000 side hustling, Then you can put $20,000 into your SEP IRA, reducing your tax burden by $20,000 and increasing your investments. The maximum that you can contribute to an SEP IRA is $56,000, so you would need to make $230,000 in business profit to max it out. SEP IRAs are good for side hustle income whether you have a 401 or not, but you can invest in both the 401 offered by your employer and in SEP IRA. You can have a solo 401, also known as an individual 401, only if you don't have any employees, and depending on your personal situation, you can actually contribute more money to a solo 401. For example, while both the SEP IRA and a solo 401 have a $56,000 contribution limit and you can contribute up to 20% of your profit into either of them. With a solo 401, you can also contribute an additional $19,000 as an employee. It's like giving yourself a company match. And remember, you can deduct all of that money from your taxable income. So if you make $100,000 profit but put $39,000 in your solo 401, you will be taxed on only $61,000 of your income. Because of this double contribution benefit, it makes more sense to open a solo 401 instead of an SEP IRA if you work for yourself, since you get more flexibility and can potentially contribute more money. Even if you have a full-time job that offers a 401, you can still open your own solo 401. But the maximum employee contribution is $19,000 total across both accounts, meaning you can't contribute the additional $19,000 to your solo 401 if you've maxed out your employer 401. But you can still make the 20% profit contribution to a solo 401 even if you have a 401 through your employer. Contribute to your FSA. An FSA is like an HSA, where you can contribute pre-tax money to use for medical expenses. But unlike an HSA, you lose any money you don't spend by the end of the year, so the benefits aren't as good. With an FSA, you can contribute up to $2,650 to the account each year. However, another benefit you should ask your employer about is a dependent care FSA, which many companies offer but few employees know about. With a dependent care FSA, you can contribute money pre-tax to an account you can use to cover care expenses for your dependents, including summer camps, daycare, preschool, and babysitting services. If you have access to a dependent care FSA and are married and file taxes jointly, then you can contribute up to $5,000 per year to your dependent care FSA. Hooray for tax-free daycare. Contribute to a 529 if you have kids. If you have children, you can open a 529 plan that can grow tax-free to cover the cost of college when your children are older. These plans are offered by individual states, and while you can't deduct your contributions from your federal taxes, some states do offer tax deductions. However, you shouldn't invest in a 529 until you have maxed out your own tax-advantaged investment accounts because the tax benefits of a 529 aren't as valuable, and you should be saving for your retirement before saving for your kids' college fund. Regardless, what you invest in a 529 can grow tax-free, and the withdrawals for eligible education expenses are also tax-free. While there are no contribution or income limits, some states do place restrictions on the total balance you can have in a 529 account, so check with your state guidelines. Step 7. Invest in taxable accounts. After you've maxed out your tax-advantaged accounts, if you still have money left over to invest, you will want to open a taxable account. If you want to reach financial independence as early as possible, then you need to be investing quite a bit of money into after-tax accounts, because the contribution limits on most tax-advantaged accounts won't allow you to retire as quickly as possible. Even in the best-case scenario with a Roth IRA of 401, and in SEP IRA, you can contribute only $81,000 a year. If you happen to be one of the super lucky ones who can also contribute another $19,000 to a 457, that will up your annual investment to $100,000, which is $1 million in 10 years. You might be able to contribute another $3,500 to $7,000 into an HSA, but that only benefits your medical expenses until after you turn 65. So, while contributing $81,000 to $100,000 into tax-advantaged accounts is a lot of money, and will definitely help you fast-track your financial freedom, you also want to be investing as much as you can into taxable accounts as well. Remember, when you invest in a taxable account, you are investing the money after you've already paid income tax on it, so you don't get any tax advantages when you invest the money or when you withdraw it later. Except in one case, any investment you hold for over 1 year is subject to the capital gains tax rate, which is typically lower than income tax rates. The most popular form of taxable investment account is known as a brokerage account, and you can open one at many companies that offer low fees. A few popular brokerages are Vanguard, Charles Schwab, and Fidelity. Look for a brokerage firm that charges you a simple low transaction fee to hold your investments, not one that takes a percentage of your investment gains. Some investment gains in taxable accounts can get taxed at the end of the year. One example is dividends that companies pay out to you in cash. These are taxed whether or not you withdraw or reinvest them. However, tax treatment on dividends depends on the type of dividend, so you should check the tax treatment for each by simply looking at the end-of-year tax statement your investment company generates or by contacting your brokerage company. As long as you've held the stock long enough, then some of the dividends might be what are known as qualified dividends, which get taxed at the capital gains tax rate, which is often lower than your income tax rate. Also, every time you sell anything in your taxable accounts, you will be responsible for paying taxes on the investment gains that year. This is why you don't want to be buying and selling a bunch of stocks in your taxable account, because it can lead to a very large tax bill at the end of the year. If the stock loses money when you sell, you can deduct up to $3,000 in losses from your taxes each year. If you lose more than $3,000, then you can carry over the losses into as many years as needed. This is called a loss carryover, and you can take it for as many years as needed until you are able to deduct all of your losses on your taxes. If you sell your investments in a taxable account after holding them for less than a year, you will get taxed at your current income tax rate. If you hold them for longer than a year before you sell them, then you will get taxed at the capital gains rate, which is typically lower than your income tax rate. A quick note on selling versus withdrawing. In a taxable account, you get taxed when you sell even if you don't withdraw the money, but in a tax-advantaged account, you get taxed only after you sell and withdraw. Yet another reason why you should be holding stocks for the long term. If you can keep your taxable income below $75,900 if you are married or $37,950 if you are single, then you won't pay any tax on your investment withdrawals from your taxable accounts. No taxes. This is one of the massive benefits of keeping your income low. Tax-free withdrawals means you need less money saved to reach financial independence. What to invest in a taxable account? You should largely keep the same investing strategy you are using in your tax-advantaged accounts within your taxable accounts. This means sticking with the same stock and bond allocation you have in your 401, 403, 457, and IRA accounts. So if you have 80% of your investments in stocks and 20% in bonds in those accounts, then you should invest the same amounts in your taxable accounts. You should also continue to invest in low-cost total stock market index and bond funds, which will have fewer tax implications each year because there is very little buying and selling within those types of funds. Hold bonds, fixed income assets in your taxable accounts. While it's a bit tougher to do, as your investment balances grow, one strategy you should consider is holding all of your tax-efficient bond funds within your taxable accounts so you will pay no taxes at the end of each year. Say, for example, you have 100% of your investments in stocks, equities across your tax-advantaged accounts, and you want to shift your target allocation to 90% stocks divided by 10% bonds. You could start investing in bonds in your taxable account if you've maxed out your contributions to your tax-advantaged accounts. Doing this means you don't have to touch your tax-advantaged account asset allocations. Plus, you will keep your tax burden as low as possible at the end of each year, since bonds typically have lower returns than stocks. Buying individual stocks. While total stock market index funds should form the core of your investing strategy, if you do decide to invest in individual stocks in either an IRA or taxable account, you should buy only stocks that you plan to hold for a long time. While it's not easy to make money picking individual stocks, your chances increase when you believe in the fundamentals of a company and hold the stock for a long period of time. Remember that when you are buying a stock, you are buying a small piece of an actual company, so you should invest only in companies in which you would be proud to be a part owner. If you do pick the right stocks, you can make a lot of money over a long period, as the value of a company grows. While there are tons of self-proclaimed stock-picking experts and individual stock investing strategies, don't listen to the noise. The individual stock investing strategy that actually works is known as value investing. It's the strategy Warren Buffett, the world's most successful investor over the past 50 years, uses. The idea is that you wait until you find a company that is undervalued and then you invest in it. In other words, you are looking for a deal. If you are interested in investing in individual stocks, check out the book The Intelligent Investor by Benjamin Graham, the grandfather of value investing and Warren Buffett's teacher. Another popular individual stock investing strategy is known as dividend investing. As you've learned, some companies share some of their profits with their shareholders in the form of a regular cash payment or distribution known as a dividend. These dividends are one of the reasons why it's smart to invest in a total stock market index fund, because you get consistent dividend payments from a bunch of different stocks. There are many investors who build a portfolio of stocks that pay dividends, so they get the added benefit of stocks that can continue to go up in value, and they generate consistent fixed income in the form of dividends. One of the risks with this type of strategy is that just because a company pays a dividend one time doesn't mean they always will, and building a collection of dividend stocks is more work than simply investing in an index fund. It is worth exploring, however, if you're interested. If you decide to invest in individual stocks, then no matter what investing strategy you choose, I recommend you invest only up to 5% of your entire investment portfolio in all of your individual stocks combined. It's not worth the risk of betting more of your money on an individual stock when you can generate consistent returns investing in the entire stock market. To help you visualize how this all fits together, when I was investing to reach financial independence, I invested 100% of my money in stocks, with 95% in stock index funds and 5% in individual equities that I plan to hold for the long haul, like Amazon and Apple. However, over time, as the value of my individual stocks has grown, now a higher percentage of my portfolio is dedicated to individual stocks because I haven't sold them. My investment portfolio. The table opposite shows most of my actual stock investment holdings between 2010 and 2015 and my savings rate when I went from $2.26 to over $1.25 million in 5 years. While I strongly recommend investing mostly in index funds, there are some individual company stocks that you might believe in so strongly in that you can't not invest in them. I started small, but during this period I ended up over-investing in individual stocks because I believed in the long-term potential of Amazon, Facebook, and Apple. I was one of the first 20,000 Facebook users while a student in college and couldn't not invest during their IPO. While I believe in these companies' missions and believed their stock would increase in value, I could never have anticipated the growth over the past 7 years. In order to diversify and mitigate the risk of owning individual stocks, I have recently been investing additional money into index funds. The key is to use a total stock market index fund as the foundation of your portfolio and build from it based on the level of risk, reward you are willing to take. This is all meant to say, be cautious with your individual stock investments, and if you are just starting out, don't invest more than 5% of your net worth into individual stocks. What is not included in the chart opposite are a few stocks that I lost money on and sold during this period. My investment in the Bitcoin cryptocurrency or any of my real estate investments. Conclusion: the more you invest, the more your money will grow. If you stay consistent, saving your first $100,000 will take the longest, but then compounding starts accelerating more rapidly and it takes you less time to go from $100,000 to $200,000 and then even less to go from $200,000, $300,000 all the way up to $1 million and beyond. And if you can just save 1% more each month, it compounds even faster. Every $1 actually makes a difference. Keep at it. While your number might feel massive and unattainable right now, the only way to get there is to just get started and take it one day at a time. If you're sitting on the sidelines because you are afraid you don't know enough about investing, don't. Getting started early is more important than waiting and making the perfect investment. And if you are sitting on the sidelines waiting to time the market, you're wasting your time. I can't do it. Experts can't do it. No one can do it. Timing the market is impossible. Play the long game. You'll learn quickly and will figure things out as you go. You are going to make mistakes. I did. We all do. You'll learn from them. An easy way to get started is through automation. You can easily set up your 401, Roth IRA, and other investment accounts to automatically deduct money from your paycheck or bank account. Most companies who manage investment accounts make it easy to set up automated investments, so you can buy shares of mutual funds, ETFs, stocks, and bonds automatically on a set schedule. The nice things about investing in ETFs are that you can buy them in most investment accounts. They have low fees, and most don't have any minimums. But automation is not enough. As we've already discussed, when you automate your finances, because you are saving consistently, you might feel like you are saving enough, but you aren't saving as much as you can. Saving enough and saving as much as you can are very different. Remember Travis. He has been automatically saving 5% of his salary in his 401 account for years, and he thinks that's enough, so he has never increased the amount he's saving each month. Keeping his savings rate at 5% will force him to keep working a lot longer than he realizes, likely an additional 20 to 30 years. We all get busy. Life happens. Priorities change. But if you want to get the best investment returns you can, you need to combine automated and manual investment management. Here's how a hybrid automated and manual investing approach works. 1. Keep increasing the percentage you are automatically contributing into your investment accounts as high as you can. 2. Manually invest all additional money you make from side hustling and bonuses as quickly as you can. For example, your 401 might be automated to contribute 10% of your salary with each paycheck. That 10% will be contributed without your doing anything. But I recommend increasing that contribution rate as much as you can over time. Try to increase your savings rate at least 1% or more every 30 to 90 days. Some months it will be easier than others. Push yourself. It's this manual pushing that will help you save as much as possible. When you get a raise or bonus, invest as much of it as you can. When you make $60 watching your neighbor's cat, invest it. It will take you a few minutes and you can do it from your phone. You can also use micro-investing apps like Acorns or Digit, which deposit small amounts of money into an investment account by rounding up your purchases or taking small amounts of money out of your account to help you invest even more money as supplement to this strategy. But these types of apps should be used only in addition to your regular automated and manual strategy as a way to save even more money. They are not sufficient vehicles for investing by themselves, as some people believe. Don't get complacent. The more you invest every day, the faster you will reach financial independence. If it means that much to you, you'll make time for it. Every $10 you invest today could help you reach financial freedom days, weeks, or maybe even months sooner in the future. Imagine how much time making that extra investment is buying you in the future. As with any strategy, use these recommendations as guidelines and customize them to align with your own financial situation, lifestyle, and goals. Just like you may need to adjust your number, you will want to monitor your progress and the performance of your investment strategy at least once a year. Tax rates and tax policies might change or other people might find new loopholes, so keep up with it. There are many people who've traveled this path before you, including me. While I can't predict the future, based on my experience and years of research, I am confident this strategy will help you perform in the top 10% of all investors worldwide and hit your number as quickly as possible. Recap. 1. Investing is the ultimate form of passive income and the accelerator of financial freedom. It's how you make money on your money without having to exchange any of your time. 2. This strategy is built on 5 key concepts you can directly influence. I. Minimizing risk. 2. Minimizing fees. 3. Minimizing taxes on your contributions. IV. Maximizing returns. V. Minimizing taxes on your withdrawals. 3. The core of your investment portfolio should be made up of stocks, bonds, and real estate. These are the easiest, most dependable investments and can make you a lot of money. 4. If you do need help investing, you can hire a fee-only financial advisor for a few hours to help you set up your accounts. You should work only with advisors who charge on an hourly or project basis, not based on AUM. 5. Step 1. Separate your short-term and long-term investing goals. You should be investing differently depending on whether you need the money in the short term or the long term. Most of your money should be invested for the long term so you can live off it for the rest of your life. These short-term investments should be in cash, CDs, or bonds. Long-term investments should be in stocks and bonds. 6. Step 2. Figure out how much you have to invest. As you already know, the higher your savings rate, the more money you can invest and the faster you'll hit your number. Sit down and think about how much money you can invest each day, month, quarter, and year. Set a foundation, a baseline number that you are going to invest in each account over each period. 7. Step 3. Determine your target asset allocation. Next, you need to determine your target asset allocation, which is the percentage of each asset you have in your investment accounts. Your target asset allocation determines the level of risk, reward of your investment portfolio and is one of the most important investment decisions you will need to make. The best way to pick your target asset allocation is based on how long it will be before you need to use the money. If you are 10 or more years away from walking away, I recommend you invest 100% in stocks for now. After you determine your target asset allocation, you should maintain it across all of your investment accounts. Readjusting your allocation rates so they align with your target allocation is known as rebalancing and should be done quarterly. 8. Step 4. Evaluate your current fees. Investment fees can have an enormous impact on how quickly your money grows, how much money you'll have within a given time frame, and how many years it will take you to reach your number. 9. Step 5. Pick the right investments. When you buy stock, you are buying a share of ownership in a real company. The individual stocks can swing wildly in value over both short and long periods of time, which can either make or lose you a lot of money in a relatively short period of time. See, research shows that, on average, 90% of active investing yields a disappointing performance compared to the stock market as a whole over a 15-year period. To keep your investments as efficient and effective as possible, you should invest in a simple fund that owns a broad selection of the U.S. stock market or a fund that owns a small piece of the biggest 500 companies in the United States. If you don't have access to either of these funds, then you can invest in funds to mirror the holdings of those types of funds. If you can ignore all of the other options, things like gold and REITs in your 401 seconds, 403 seconds, or IRAs. While they can add more diversification, they aren't really necessary and you are better off focusing just on stocks and bonds in your asset allocation. Keep it simple using index funds when you can. 1.0. Step 6. Max out your tax-advantaged accounts. Taxes can take a massive chunk out of the future earnings of your investments, so it's important to minimize their impact as much as possible. The key to getting the maximum tax benefits is to strategize when you put money into your investments and when you take the money out of the investment. See, you can invest in 3 types of investment accounts. Tax-free contributions. Tax-advantaged accounts in which you don't pay taxes when you invest the money, but you do pay taxes when you withdraw money. Tax-free withdrawals. Tax-advantaged accounts in which you pay taxes before you invest the money, but don't pay taxes when you withdraw money. Taxable accounts in which you pay taxes before you invest the money and also when you withdraw it. 1. Step 7. Invest in taxable accounts. After you've maxed out your tax-advantaged accounts, if you still have money left over to invest, you should open a taxable account. Every time you sell anything in your taxable accounts, you will be responsible for paying taxes on the investment gains that year. See, if you sell your investments in a taxable account after holding them for less than a year, you will get taxed at your current income tax rate. If you hold them for longer than a year before you sell them, then you will get taxed at the capital gains rate, which is typically lower than your income tax rate. 2. Automation is not enough. Here's how a hybrid automated and manual investing approach works. Keep increasing the percentage you are automatically contributing into your investment accounts as high as you can, and manually invest all additional money you make from side hustling and bonuses as quickly as you can.